Good day once again. Welcome. This is David, Etienne Business Solutions, Certified Public Accounting. Happy to have you back to one of our little chit chats, I like to call it. The official name, I'm told, is a podcast, but we just have a little chit chat, getting up to speed with a couple of things. Now, this for this little session, I want to spend a couple of minutes looking at Wassail. Now, whenever a person acquire an investment, that's exactly, terming it or classify it as an investment would imply that this person is putting his or her resources into this item, this property, this security, with the intention that at some point in the future, he or she will be able to make a gain. That's what it's all about. Okay? And so we speak of this speculative intent where I'm going to hold on to an investment, and as soon as I see where I'm in a position to make a gain, then I'm going to liquidate, sell, and make a gain. So we had spoken some time back about capital gains. And we spoke of realized versus unrealized gains. And just a quick recap, we mentioned that if on the books you see the value of your investment going up, it is really a book increase, a paper increase. It is referred to as unrealized gain, meaning that the current value of that asset is greater than the original purchase price, or even what we refer to as the basis, which is another concept which we'll not touch on this afternoon. But bottom line is that if the current value of your investment is greater than what you have it as on the books or what you had acquired it for, then you are showing a gain. But this is a paper gain, a book gain. It is an unrealized gain which can only be converted to realized gain when you have sold, when you have liquidated. Good. Having said that, we're moving now to this concept of a wash sale. Now, if a person invests in an investment and they're watching for an opportunity to make a gain, a larger gain as possible, then it's obvious that this person will be ready to dispose, be ready to sell the minute the market indicate that, hey, I can get a much higher price for this investment compared to than what I had bought it for back then, a year, 2 years, 3 months, whatever later. Now, we have to distinguish between what is referred to as long-term versus short-term. Once you acquire, hold, and dispose of an investment in less than a year, we refer to it as a short-term investment. Greater than, we refer to it as a long-term investment. And that has implications for disposing of such an investment to realize the gain. So if and when we dispose of an investment, and to the extent that we have made a gain, it can be a short-term capital gains or it can be a long-term capital gains, depending on the period over which we held the investment. And that period is that time between acquisition and disposal. Now, if you acquire an investment and you subsequently sell that investment in the short term, less than a year, then whatever gain that you would have realized is referred to as a short-term capital gain. This capital gain is subject to capital gains taxes, and the tax rate applicable to short-term capital gain is different from that applicable to a long-term capital gains. As a matter of fact, where you have a short-term capital gain, then the tax on that is at a usually a higher rate than if it was a long-term. where you have a capital gain that is classified as long-term, meaning that you held the investment, the security, or the asset for greater than a year before disposing, then any gain on that is referred to as a long-term capital gain, and that is taxable at your ordinary tax rate, meaning the tax rate that is applicable to your other ordinary income. All right? Now, the implication here is that if I have an investment and I'm holding it most naturally for speculative purposes, and I'm going to jump on the opportunity to sell and make a gain as soon as that opportunity presents itself, I need to be cognizant of the fact that the tax implication on that gain will be different depending on whether or not I sold the investment within or less than that 1 year period, as compared to if it was sold for a period that is greater than a year, because that now will give rise to either short-term capital gains or long-term capital gains, and the attendant short-term capital gains tax rate as opposed to the long-term capital gains tax rate, which I said to you before, once it's long-term, then it more mirrors your normal tax rate that is applicable to your ordinary, your normal ordinary income. Coming back now to the whole aspect of wassail. It is saying that if you have an investment, if you acquire this investment and you see the opportunity to sell the investment, why? And how did that opportunity present itself? Because when you look at the value of the property, it has increased. So you have this investment at 50,000. Based on market conditions, the value has moved up to 70,000. And so you see where there's a book increase, there's a book gain, there's a paper gain of 20,000, a movement from 50,000 to 70,000. But it is unrealized up to this point. And remember, unrealized gain has no tax implication. Now let's flip the coin and look where you had bought this investment for 100,000, and based on market conditions, you see where the value has gone down from the original 100,000 purchase price to a current value of 70,000. So you have a capital loss, but this again is an unrealized capital loss. Assuming that you have other taxable ordinary income, you may be interested in finding some way to realize this 30,000, where I said 50 and 7, that's 20,000, this 20,000 capital loss, in order to have a write-off against a tax bill on the ordinary income. So here's a rule of the wassail. Nobody's preventing you from selling your security or your investment within a week, 2 weeks, 3 weeks, 3 months, a year. It's up to you. However, the rule is saying if you liquidate or sell this investment and you recognized a capital loss on the sale, then you will only be allowed to use this loss to offset other tax bills if you had not acquired similar investment in the 30-day prior or the 30-day subsequent to the sale of this. So there's what we call the 61-day rule. 30-day prior, 30-day subsequent to the sale, and then which is 60, and then on the 61st day, you would have been in the clear. And why is this very important? Picture this. You have an investment, you bought it for 70,000, just use a number. You look at it 3 months down the road and you see where it has moved from 70 to 50,000. So there's an unrealized loss of 20,000. Keep that in memory. Bought for 70, current value is 50, so there's an unrealized capital loss of 20,000. Unrealized because it is just shown on the books. I have not yet sold this investment for the loss to become a reality. It is not yet realized. It's sitting there. Let's put that bit of information aside. I turn to my bigger tax picture and I see where, based on my other income, my ordinary income, my salary, my earnings from consulting work, etc., 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 I see where I'm going to have a whopping tax bill based on those other ordinary income. And I'm thinking to myself, oh, well, maybe what I can do is to liquidate this investment that is showing me a paper unrealized loss of the difference between the 70 and the 50, which is the 20,000. If I liquidate, if I sell this investment and therefore convert this unrealized loss into a realized loss, then I would have the opportunity to apply that loss against the tax burden that is coming along with my other taxable income. And I can always turn around and quickly repurchase those investments because I'm only liquidating them in order to make what was unrealized loss become a realized loss, so I can get to apply that loss against my other taxable income. But the minute I do that, the minute I sell these things to be able to convert unrealized loss into realized loss, I'm going to turn around right away and reacquire the investment, the similar investment. What would that mean? It means, therefore, my position would not have changed. Yes, maybe for a day or two, I would not have been in possession of this asset, but I own it now, I sell it, and in a short time, I reacquire, just so that I can make real the loss that was not real while it was unrealized. So you see, a person could take a lot of advantage by doing this, disposing of an asset that is showing a potential paper loss, realizing the loss to be used to offset other tax implication and other income, and quickly turn around and reacquire the property. And so all you'll be doing is liquidating in order to get that loss to reduce your other tax bill. That is not a loss. That is called a wash sale. So the rule of the game is saying you can always sell your investment and your property whenever you want, or however often you want. But remember, if you do that and you incur a loss, you will not be allowed to apply that loss to other taxable gains in order to reduce your overall tax bill if you had, within 30 days prior to the sale or 30 days subsequent to the sale, if you had acquired similar assets, similar investments, similar properties. Okay, because that would be saying that you're only liquidating to get the benefit of this loss to reduce your other tax bill, because the minute you do that, the minute you sell, you have gone back and reacquired the similar type asset. That is called a wassail, and so you can do that, but you will not be allowed to utilize this loss to offset other tax bill on other capital gains or other ordinary income. Key point to know, that is your wassail. And this is very important because especially now, based on what is happening in the market overall, there are a lot of opportunities for individuals to, do these things, liquidate. You see where, your assets are just escalating in terms of value. Things are going up. Your the 2-bedroom home that you had in rental now is just whopping in terms of the price on the market. You're thinking, okay, I can sell and make a whopping profit and thing. So there's a lot of shuffling around of things on the investment horizon, and it's all good. There are monies to be made in any economic situation. There are always sectors that stand to make a lot of money, but then you ought to be cognizant of the rule of the game, the tax implication, the rule of the game. So that is it for you as far as Wassail is concerned. So bear that in mind, and also look at it in the context of the overall picture of this whole capital gains, unrealized and realized, capital loss, unrealized and realized. Okay, and how you would convert it from one form into the other, the tax implication of it, the offset between capital gains on certain investment and the capital loss, and also the application of carried forward losses that can be used to offset future capital gains or even future tax bill on ordinary income. Also bearing in mind that if it is used to offset future capital gains, then there's no limitation. But if you're going to use carried forward capital losses to offset future tax bill on ordinary income, then there's a limitation of that $3,000. Okay, very important. So I just thought I would share that with you, and I leave that for you to chew on and to get an understanding of it. So this is David saying, that's my bit for the day. Have a good one, and as usual, do not hesitate to be informed. At the heart of it all, what distinguishes a businessman from a man who is just trying to run a business, my way of putting it, is really your search and your yearning and your appetite for information. That is what drives business. Information. Without information, you're just groping in the dark. Okay, so this is David saying bye for now, and I just need to just remind you, or to inform those who are not aware, that we have a YouTube channel, Etienne Business Solutions, and a YouTube channel, Etienne's Place, and there's quite a bit of video presentations here on a myriad of topics, business topics, that you may find to be quite informative. So check us out, Etienne's Place, and see what you find there that will be of use to you. And of course, go ahead and subscribe to our channel, because we'll be putting out these short podcasts, video presentations, you name it, from time to time, and you, I think, would want to be kept informed so that you're kept up to speed and aware of what is happening. So bye for now, and we'll be talking soon.